Alright class, today we're going to explore the types of accounts in accounting, which form the core framework for any financial recording system. Understanding these types and their roles will give you clarity when making journal entries and analyzing financial data. Let's begin by listing the main types of accounts and then delve into what each type means with examples for better understanding. Types of accounts in accounting. Assets. Liabilities. Equity. Revenue. Now, let's break these down one by one with examples. 1. Assets. Definition. Assets are resources owned by a business that have economic value and can provide future benefits. These are things the company owns and uses to operate effectively. Examples. Cash. Money available in the company's bank account or on hand. Inventory. Products or raw materials that the company intends to sell. Equipment. Machinery used for production or office operations. Accounts receivable. Money owed to the company by customers for goods or services provided on credit. Explanation. When a company purchases a vehicle for business use, we debit the vehicle account, an asset, to show an increase in assets. For example, if the company buys a truck for $20,000, the journal entry would be debit vehicle $20,000. Credit cash bank $20,000. 2. Liabilities. Definition. Liabilities are obligations that the business needs to pay back in the future. These represent what the company owes to external parties. Examples. Loans payable. Money borrowed from a bank or financial institution. Accounts payable. Amounts the company owes to suppliers for goods or services received on credit. Wages payable. Salaries owed to employees but not yet paid. Taxes payable. Amounts the company owes to the government for taxes. Explanation. If a business takes out a loan of $50,000 from a bank, the entry would be debit cash bank $50,000, increase in assets. Credit loans payable $50,000, increase in liabilities. 3. Equity. Owner's equity. Definition. Equity represents the owner's claim on the assets of the business after all liabilities have been deducted. It is essentially what the owners own after debts are settled. Example. Capital. The money invested by the owners into the business. Retained earnings. The accumulated profits that have not been distributed as dividends and are kept in the business for future growth. Drawings. Money taken out of the business by the owner for personal use. Explanation. When an owner invests $10,000 in the business, the entry would be debit cash bank $10,000, increase in assets. Credit owner's capital $10,000, increase in equity. 4. Revenue. Income. Definition. Revenue accounts track the income earned by the business through its main operations. This could come from selling products, providing services, or any other income-generating activity. Example. Sales revenue. Money earned from selling goods. Service revenue. Income from providing services. Interest revenue. Earnings from interest on investments or loans given. Explanation. If a business earns $5,000 from sales, the entry would be debit accounts receivable cash $5,000, increase in assets. Credit sales revenue $5,000, increase in revenue. Expenses. Definition. Expenses are the costs incurred by a business to generate revenue. These accounts record the outflow of money or assets and decrease the company's equity. Example. Expense. Cost of leasing a space. Salaries expense. Wages paid to employees. Utilities expense. Costs for electricity, water, etc. Depreciation expense. The allocation of the cost of a tangible asset over its useful life. Explanation. If the business pays $2,000 for office rent, the entry would be Debit rent expense $2,000, increase in expenses. Credit cash bank $2,000, decrease in assets. Why these accounts are important. Understanding these types of accounts is crucial for recording transactions accurately and maintaining the balance in the accounting equation. Assets, liabilities, equity. Each type plays a role in determining debits and credits in journal entries. For instance, assets and expenses increase with debits and decrease with credits. Liabilities, equity and revenue increase with credits and decrease with debits. Quick recap. Assets, what the company owns, debit to increase, credit to decrease. Liabilities, what the company owes, credit to increase, debit to decrease. Equity, owner's stake in the company, credit to increase, debit to decrease. Revenue, income earned, credit to increase. Expenses, costs incurred, debit to increase. These concepts form the foundation of how accounting entries are made and help ensure that financial records are accurate and balanced. Understanding these basics is vital as you continue to study more complex accounting topics.